So, you've heard about investing in the stock market, but maybe it feels complicated. Well, you've come to the right place. We're going to break it all down, piece by piece. My goal here is to give you a clear, simple roadmap so you can feel confident taking those first steps. And look, if the whole idea of stocks feels confusing or maybe even a little risky, you're not alone. That's a completely normal feeling. But today, we're going to trade that confusion for clarity. Here's how we're going to do it. First, we'll cover the big why. Why even bother with this? Then we'll get right down to the basics of what a stock actually is. After that, we'll explore your different options, I'll walk you through how to actually buy a stock, and we'll wrap up with what is honestly the most important piece of the puzzle, having the right mindset. All right, so let's start right at the beginning. Before we get into any of the how-tos, we really need to understand the why. Why should you even think about putting your hard-earned money in the stock market in the first place? It really boils down to these 4 key ideas. First, and most importantly, it's one of the most proven ways to build wealth over the long haul. Second, and this is a big one, your cash is quietly losing its buying power every single day because of inflation. Think of it this way. That $100 you have stashed away today will buy you less stuff next year. Investing gives you a chance to outrun that. On top of all that, it's just never been easier to get started. And finally, let's just get this out of the way. You do not need to be some kind of financial genius. Patience is way more valuable than brilliance here. Okay, so we've got the why covered. Now let's dig into the what. We're going to look at the single most basic building block of the entire market, the stock itself. At its core, the idea is actually incredibly simple. A stock is not just a ticker symbol or a number flashing on a screen. It's real. It's a tiny piece of ownership in a real company. When you buy even one share, you become a part owner of that business. To make this really click, let's use an analogy. Just picture a big company you know, and imagine it's one giant pizza. The whole pizza is the entire company. So if the company is the pizza, then each share of stock is simply one slice. The more shares you buy, the more slices you own. And if that pizza business does well and becomes more valuable, well, so does every single one of your slices. So how do we know what the whole pizza is actually worth? That's something we call market capitalization, or just market cap for short. The math is simple. You just take the price of one slice, the share price, and multiply it by how many slices exist in total. That number gives you the true total value of the company. And it's a much better way to understand a company's size than just looking at its stock price. Now, of course, not all stocks are the same. We tend to group them into different categories to make sense of them all. You can sort them by their size, their market cap. You can sort them by their strategy, like a company that's focused on super fast growth versus one that pays out steady income. And of course, you can sort them by what they do, their industry, like tech or healthcare. Knowing these categories helps you build a balanced plate. Okay, we absolutely have to talk about the other side of the coin, risk. It's a word that can sound pretty scary, but it doesn't have to be. So let's be really clear about what it actually means. So what is risk, really? At the end of the day, it's just the possibility that what actually happens is different from what you hoped would happen. You might buy a stock expecting it to go up, but it could go down instead. That gap between expectation and reality, that's risk. In fact, the potential to earn a return exists because you're taking on that uncertainty. The goal isn't to avoid risk entirely, it's to understand it and manage it wisely. All right, now we know what a stock is, and we have a handle on risk. So let's look at the different tools you have to actually own stocks. There are a few main ways to go about it. Let's look at the 3 most common options. First, you can buy individual stocks. This gives you total control, but it's also higher risk, right? You're putting all your eggs in one company's basket. Next up are index funds. These are fantastic because they let you buy a tiny piece of an entire market like the S&P 500, which gives you instant diversification. The trade-off is that if the whole market takes a hit, so do you. And then there are ETFs, which are kind of a hybrid. They're basically a basket of stocks that you can buy and sell just like a single stock. They're super flexible and low cost, but you do need to be aware of what's inside to make sure you're not too heavily weighted in just one sector, like technology. Okay, let's get down to brass tacks. We've talked about the why and the what. Now, let's walk through the actual step-by-step process of how you go about buying a stock. It really just comes down to these 4 simple steps. Number 1, you decide what you want to buy. Number 2, you choose how you want to buy it. That's called an order type. 3, you might set a specific price you're willing to pay. And 4, you hit the button and confirm the whole thing. That's really it. Now that second step, the order type, is super important. So let's focus on it for a second. A market order tells your broker, buy it for me right now. at whatever the best price is. A limit order is different. It says, hey, only buy this stock for me if you can get it at this specific price I want or even better. For beginners, using a limit order is a really smart move because it protects you from paying more than you wanted to. We've now arrived at our final section. And honestly, this is the most critical part of all. You can learn all the mechanics and the terms, but what truly separates successful investors from everyone else is their mindset. Let this one really sink in. Investing is not the casino. It's not about hot tips or getting lucky on a long shot. It's a skill that you develop over time, built on a foundation of patience and discipline. And that brings us to maybe the most powerful advantage you can have: time. When you start early, you give your money more years to grow and harness the incredible power of compounding. It also gives you more time to learn from the small mistakes you'll inevitably make along the way when the stakes are smaller. Time is truly your greatest asset. So there you have it. We've gone through the why, the what, and the how. You now have the foundational knowledge to begin. So the only real question left is the one you have to answer for yourself. What is your first step going to be?